Well, here we are again, everyone. Greetings and welcome to the show. I'm John Clay, your host and chief strategy guide. Hope you're doing well and enjoying your time in the sunshine. Speaking of sunshine, my grandfather always said, Son, the sun doesn't shine on the same dog every day. If the dog doesn't move, the sun will. Well, thank you, Gran, for that quote. It always made me scratch my head as a younger man. But in today's world, we see the new inflation figures are out for June, and now we've gone from 8.6 to 9.1 increase in inflation. So, ooh, inflation is kind of like sunshine. It's fun and exciting until it starts to burn. And I think we're in one of those situations right now, the highest inflation in 40 years. But we're going to talk about a new topic this year or this week called worst case self funding insurance scenarios. Before we do, I want to give a shout out to our show sponsor. Today's show is sponsored by none other than Better Source Benefits. Benefits Option Solutions. Check it out at www.bettersourcebenefits.com. So today we're talking about worst case self-funding insurance scenarios. As I've mentioned before, nothing is more freeing than taking control of your medical plan. You know me as an advocate for self-funding insurance, and when done right, it's life-changing for both employers who make the most of every dollar they spend on healthcare and their employees who can always feel safe and secure working with benefits that deliver financial security and better outcomes. However, there are exceptions. Well, I would say situations when a self funding plan has gone bad. And I don't mean bad, I mean really bad. Employers who have doubts about handling risk and self funding are usually terrified of both. They've heard for years this is, risky stuff and things of that nature. But let's be honest, most of the time that fear is abstract. For those that have stepped across from the fully insured to the self funded experience, the majority of them, we're going to say that's been well worth the effort. But more importantly, how to keep yourself and your company out of high risk situations. We're going to talk about the worst case scenario for your small employers. Employers who sponsor health plans for their employees in a traditional sense can purchase insurance contracts to fund those plans. Alternatively, employers can self-fund or self-insure those benefits, agreeing to pay the claims themselves. Many employers who provide these self-funded plans also buy a stop-loss insurance to cover the risk of exceptionally large claims. However, employers must be careful that their stop-loss coverage provides adequate protection. And we've got a case right now going on in Alabama that highlights the risk of a disconnect between the employer's plan and the stop-loss coverage. This employer changed to a self-funded plan and purchased stop-loss coverage that provided benefits for member claims that exceeded $75,000 up to $1 million and a lifetime max of $1 million. The employer thought that the health plan imposed a $1 million lifetime max on all benefits. However, the Blue Cross plan that the employer had offered its employees had a lifetime max for only certain services, such as out-of-network coverage. Other services did not have a lifetime max. Under healthcare reform's footnote here, under healthcare reform, all plans must eliminate lifetime maxes for essential health benefits. So in the future, employers should have less difficulty understanding this portion of their plan design. But back to the reality is, this is not the case we're talking about here today. So what happens? Well, we have a participant in the employer's plan who had premature twins, gave birth to preemie babies. One of these preemie babies had a serious medical condition and quickly amassed a ton of costly medical benefit bills amounting to over $2.8 million in claims. These claims were incurred over a several-year period, however, and that series of claims exhausted the max stop-loss reimbursement, and the employer found itself paying, get this, an additional $1.8 million in claims above the stop-loss. The employer sued a number of vendors to this plan, you can imagine, and they included the insurance agents, Blue Cross, and everyone claiming that they should have alerted the employer to the difference between the plan design and the stop-loss coverage. Although the employer suggested a number of legal remedies for all of this, the court has rejected most of them, and those theories haven't played out in their favor just yet. But all claims against Blue Cross were dismissed, and most claims against the insurance agents were dismissed. But the one remaining claim was a breach of fiduciary duty claim. As you all know, if you're in the C-suite with the chief financial officer, you have that fiduciary duty imposed upon you, especially under ERISA plans. So the argument there was from the employer that the agents had a special relationship with the employer in the design of the plan and the placement of stop-loss coverage. Because the agents were purported to have acted as trusted advisors in the transaction, the court refused to dismiss the claim. Thus, the employer will have the opportunity to show the court that there was a fiduciary relationship between the insurance agents and the employer, and that the insurance agents and the employer should cover the losses not covered by the stop-loss insurance. Mainly the insurance agents. You know, we're talking about errors and omissions and all that kind of stuff. But one impediment to this whole action is that the employer will have with it its claims related to the fact that stop-loss coverage is not issued on a guaranteed basis. In other words, each annual review, stop-loss carriers can re-underwrite coverage and reduce their risk by limiting particular claims. And it would sound funny if that wasn't the case here, but the medical claims of the baby were insured over several policy years. So here's the wrinkle. Even if the stop-loss coverage had not contained a lifetime limit, after that first policy year, it was likely that the stop-loss carrier would have refused to cover the medical claims of the child or would have severely limited the extent to which it would have provided stop-loss coverage in any event. Thus, it's not clear that the employer could have obtained an adequate stop-loss protection once the premature baby was born, and it was known to all parties that there would be substantial medical claims in future policy years. Typically, we would call those lasers or exclusions, and we'll have to see what the rest of that case plays out. But there are at least two lessons in all of this. There are at least two lessons for the employers. First, make sure that if your plan is self-funded, your stop-loss coverage does not have restrictions and limitations not reflected in your plan design. I call them fish hooks. There should be no surprises in the congruence between your plan and your stop-loss. No one wants a surprise, especially a $1.8 million one. And if there are, that you're aware of those differences and are comfortable accepting the risk. Second, understand that even if you are under a traditional stop-loss coverage consistent with your plan design, a high claim that continues through multiple policy years is likely to be reviewed and have some sort of limitation or exclusion from stop-loss coverage after the first policy year, a laser or an exclusion for certain conditions and so forth. That's what happens with traditional stop-loss. You need to understand that one of the risks of self-funding is that adequate stop loss coverage might not be available for claims that span multiple policy years. Just that simple. Now let's talk about how we can avoid having this situation for your self-funded plan. Long-term stop loss scenarios exist in today's market for just about anything. No laser contracts are available. Guaranteed renewable contracts are available. And they're just a small sample of the solutions that we have for employers and transferring risk in the benefits toolbox. So my background includes development of prescription benefit management solutions, which can really get into the pockets of a health plan, provider network evaluation, valuation, and negotiation, and underwriting. I work with multiple partners, and I focused work on the arena of alternative or self-funding for the last 5 years. My current role is focused on support of employers to optimize the PBM and managed care and provider excess practices that transcend into self-insured plan sponsor benefits. I invite you to check us out at www.bettersourcebenefits.com and click on our results tab to see how we're letting the sun shine on our clients. And of course, if you want to get started, click on that Get Started button and book a session with me, a complimentary session. I'm glad to invest a little time with you to get to know you. And I'm John Clay, your Chief Strategy Guide. So that's it for today. Worst self-funding insurance scenarios and how to avoid getting burned. I hope this has been of value for you, and thanks for watching, and thank you for the positive comments on the shows. We always look forward to our next time together, Wednesdays at 2 p.m. Eastern. Sorry for the technical difficulties today, but I'm John Clay here on Benefits with John Clay, and we'll see you soon.